Let's talk about the psychology of gap trading. I think it's really important to always think about the psychology of any setup you're trading because it's just so key. You know, the whole thing about charts is they're essentially a visualization of the groups, their thoughts and feelings on any given chart. So it's really key to essentially try to get in their minds and see why it's moving how it's moving, because understanding that will help you predict what it's going to do. And that's the game here, right? In terms of market maker behavior, they provide the gap fill liquidity, and they like to do this because remember, market makers get paid off of the number of transactions, not on whether a price goes up or down, because they are constantly on both sides of a trade. Because of that, you really want to watch these key levels. You know, when the gaps fill, what does price do? Because just getting the gap fill is not confirmation of anything other than market wanted it to go there because there were a lot of orders to fill there, you know, and it really can be that simple. So because of that, really important to keep that in mind. Retail panic patterns are really important to watch for too. So these emotional gap patterns, they can create continuation opportunities where a stock can gap up and it's just such a big move that people are like, oh, I'm going to fade this. A lot of people just hammer it open, right? And the initial push down that they provide, that knee-jerk reactive push down that does not align with the fundamental change in the stock, that can provide a really good opportunity to buy that pullback that they create and push the market up and get that continuation pattern. We can also talk a little bit about institutional footprints. So that would be essentially using big volume patterns to kind of help reveal the positioning of these institutional investors. By that, I mean, when you see big volume sticks, either on the volume chart on the bottom of your screen or on your volume profile at a certain level, that can help you pinpoint just where institutional investors are positioning. And you can use these levels as essentially levels of resting support. So they're boosting it off of this key level, you know, whatever it may be. If you're an investor, you're not hopping in and out of positions every 5 minutes, right? I mean, sure, there's tons of different algorithms and stuff, but in general, the biggest resting volume, the volume that actually pushes these moves into continuation plays, they're institutions that believe in the stock going significantly higher. They're not here for 5%. They're here probably for 10 to 20 to 30 to 40%, that kind of thing, right? So because of that, we are looking for just the casual drift down off of their buys. They buy here, it surges up because everybody's like, whoa, look at that volume. When it comes back to that level, we can use that as support to risk off of. We can say, hey, maybe we missed the pop, but we're looking to basically ride the coattails of these institutions. The last thing is just your emotional management too. It's really important to have a pre-planned route and to execute that plan accordingly.